Why does it appear that the investment grade market is not as impacted by today's conditions as the high yield or the leveraged loan market?
Well, there's a heightened sense of risk aversion in the leverage market and a different buyer base. And that buyer base is largely now retail funds, and we see fund flows in and out every week. They're reacting to the headlines and extremely nervous. The investment grade market is solely reliant on banks. Now, banks are facing certain struggles. They're looking at rising cost of funds in Asia and in Europe. They're also struggling with moving to their core relationships and reducing capacity in certain ways. But even though we're seeing that in the U.S. market, it has not really reduced capacity. We're only seeing it at the margin in terms of the impact. Deals continue to be oversubscribed because banks continue to have appetite for these higher quality assets.
What are the types of M&A that will predominantly use investment grade financing?
In the investment grade market, the M&A financings tend to be bridge loans, so they're very short-term financing, and it's supporting the issuer to the capital market. So it tends to be fully funded. Now, investment grade M&A financing this year alone has surpassed $100 billion. If you compare the last 2 years, it's been about $40 billion each year. So really powerful, a lot of issuance, and you're like, how'd this happen? So banks are really hungry for these type of assets, for these bridge loan assets. We've seen some landmark deals this year. So for example, the AT&T bridge loan, that was a $20 billion bridge loan solely underwritten by JP Morgan, supporting their acquisition of T-Mobile. This was one of the biggest bridge loans we ever seen. Express Scripts had a $14 billion bridge loan. So banks are really hungry for this type of asset, and that's how they're supporting these M&A type financings.